Hey guys, Jay here, the smarthelping.com. I've got a new template. It's exciting. It's function as a service, also known as serverless computing. This is for cloud service providers that want to simply offer function execution as their main service. So you sign on customers and they bill based on what they use of your um, hardware, which is going to provide function execution. Now, the reason why this is becoming a big thing, and there was platform as a service, or there was infrastructure as a service, platform as a service, and now like the latest efficiency upgrade to the whole cloud computing services, and you can see this, I think, on AWS Lambda, is function as a service. And I've spent quite a bit of research here trying to understand the unit economics of how this can work. So I want to jump. So there's some main project level assumptions here to account for the timing, end of the forecast, but I want to start with the revenue assumptions on this model. So you have 6 acquisition channels plus organic traffic, and this is how you're going to figure out how many customers sign up. Now the main, and this is the best in practice retention logic and customer cohort modeling used that is available out there. It's the most accurate way to forecast subscription models. So we want to know how many customers exist over time. We have the signups, which can be defined here, or on the monthly detail, you can manually put in how many customers you plan to sign up right here. And this is where the assumptions flow, but you can override this if you want to manually define new customers. Now, where all the cool magic happens in logic is I have matrix tabs on the end of the model here, T1 through 6, that have all of the logic, but we can see how many customers exist over time, what the churn is over time, and that's all defined down at the lower part of this in customer retention and promotion options. So here, the promotion option just applies to any subscription pricing. This is if you're just going to charge a one-time monthly fee and basically give customers limits. That's one option. The other option is pay per use, which we'll go through. But if you're doing the subscription fee method, you can offer promotional months where they only pay a certain percentage of the full price for month 1 or 2, and then by month 7, you will have that up to 100% of whatever the base billing rate is for your subscription. If you're not doing subscription pricing, that's fine. Zero this out, no worries. And you still want to keep this contract length. Now, contract length doesn't necessarily mean you could have month-to-month contracts or whatever, but this is essentially saying there's some renewal point every X amount of months, and at that renewal point, you retain X% of your customers. So here on the retention curve, these are renewal points, which might be every 12 months or 6 months or whatever amount of months are defined here. And you can put how many customers remain over time all the way through to 72 months. So this is, you can use exponential decay curves, linear curves. You just want to say an average amount of your initial customers that are signed up stay for over a certain amount of time. But this is really good logic to understand how many customers exist over time. And you can do up to 6 tiers. I've also got a light version. The light version is much faster, but it's only got one customer tier. So here you can just define one, all your customers are of one type. There's one configuration for each one, and the retention here is just for one. This is much faster, but then you don't have up to 6 customer types. Uh, Both are included in the purchase when you go to the download page, and I thought that was really good to have a light version and a heavy version. So back to the heavy version here. Let's talk about why function as a service is so good real quick and how works. So function as a service is like if a company is scaling and let's say they want, you've got a kitchen, the fridge freezes things, the coffee maker makes coffee, the toaster makes toast, and let's say you need a toaster, you need 5 toasters. Well, instead of buying a whole new 5 new kitchens, so you have 5 toasters, you can just buy 5 new toasters for that kitchen. Or let's say you needed 6 refrigerators. Instead of buying 6 whole new kitchens, you can just buy 6 refrigerators. You don't have to have that extra waste of paying for something you don't want. So customers don't want to pay for what they're not using, and there's inefficiencies there. So function as a service just says, okay, customer, you can have execution of functions, and you get a certain amount of GBs, usually it's measured in or megabytes of performance, and you're charged based on how many GB seconds are used, and that's how we price it, just on usage of the hardware. So if we get down here, usually from what I saw, there's always an option, or often a free tier option, where the first X amount of GB seconds used are free, and the first amount of requests are free every month. So like maybe the first million requests are free, and then it's 20 cents for every 1 million. You can see here price per 1 million functions requested. And then also with the GB seconds, this is saying, okay, if you've got this many requests happening per customer per month, it takes this amount of seconds for each function to run on average. You're using 525,000 seconds in this case. You multiply that by the amount of GBs allocated to the customer, 1.5, and that gives you your what you can bill at. So that is GB seconds, and you can bill that at this rate here, which you can define. So that's the main revenue stream. So pay per request and pay per GB seconds used. There's also potentially data transmitted in the function, and what these functions do is it turns on and off as it's used. So as the customer needs to has a software, or they're writing software and it's triggering, okay, we need to do something, the function as a service provider does the function, executes it, and then turns off. So it's efficient for both ends, and it provides, depending on how fast, you could pay for different levels of GBs. So you could have a 1.5 gig, you could have less than that, more than that, and obviously higher GBs here is going to cost more. Lower GBs would cost less. Um, so that's generally how I've thought about and what I've researched the best way to do pricing on functions. If you're a cloud service provider doing that, this is the base level units I was able to come up with that made sense to me, and I've checked these a lot to make sure the logic makes sense and works so it's industry standard. And again, data transmission, maybe every function runs on average for depending on the customer type, maybe a certain amount of data has to go out or into the system or network. And in that case, there will be data transmission fees. And the cloud service provider may or may not charge for that depending on how big it is. This is more for like streaming and stuff like that. But you can put the amount of GB sent per request and the price per GB as another revenue source. Now, even if you are just using the subscription tier and you want to see what the economics of that look like, essentially what you need to charge each customer to cover your costs. Let's say you are using this, but and not these functions, you can then zero this out. But you want to keep in the activity. So you don't want to zero out this average functions per month per customer, because that's going to drive your variable costs. So you want to know what that is, even if you're not charging based on that. If customers are using that, your costs are going to be based on that. So you need to have that in there for each customer type that you're using. And then the same idea with the GB sent, because there's variable costs with this as well. This wouldn't be relevant. This wouldn't be relevant. This you want to keep in. You want to keep in average seconds per function. Actually, no, I don't believe that's used. Just mainly this one for your variable costs. Okay, so that's everything on the revenue tab. Let's go to the customer scale. So this tab allows you to find how many functions, or what the growth of function usage is of a given customer over their lifetime. So it's going to grow whatever this starting amount is. So let's say you think these customers are going to come on average, start with 3.5 million function requests per month. And then in month one, there's going to be 1% more. In month one is the base, and then month two is going to be 1% more, etc. 1% more again in month three. So this is just to account for a customer cohort type that has more activity over time. So, and as more functions are requested for a given customer type, that's going to affect all the economics. And this model dynamically looks at how many customers exist over time. Of the customers that are remaining, where are they at as terms of function usage? And again, all this logic is happening here. Like if we look at the T1 tab, this last three does the scaling. So function to use, you can see this is taking the usage growth basis. So this is, cohort 1 customers, and then it's calculating what their average function usage is per month, and then that's per customer, and then we're multiplying by, and this is to figure out these percentages drive this. And then once you know the usage per customer, you can define that by the customers remaining, which is right here. This is the logic for customers remaining over time for each monthly cohort for customers that joined for tier 1, and then you multiply that by that customers remaining times function usage to get the actual functions used over time. So you can see this actually can grow. In this case, it starts to grow when you're not losing that many customers, but the customers that remain are still growing a little bit in how many functions they're using. So you can define the growth schedules however you want here for each customer type. It could be 0%. It could be higher in the first few months and then slowly get stabilized, whatever the case is. Very dynamic. I wasn't going to add this, but I thought, you know what, it's not likely that there's no customers that you want to model out a average growth. Like it's just, you're going to have customers that use more functions in month, after they've been a customer for 2 years compared to when they first signed up. Now there could be other customers that are come on and maybe it's stabilized. Like they have a set amount that they think they're going to use, and that's just whatever they use. The point is you're billing per usage of GB seconds and function requests. Okay, so that's the revenue. On expenses, we have fixed costs. So these are just like, let's say software developers, executives, legal fees, any fixed costs that are not accounted for in the anywhere else you could put here that are fixed monthly costs. You can adjust the cost each year. And if it's a salary item, you just put a 1 in this row or this column, and that will then apply a payroll sales or payroll tax to that. Taxes and benefits, which you can define down below, right here, row 143. Now, so you have fixed costs. You also have customer service reps. So this is the main type of payroll that I wanted to scale based on the number of customers a single rep can handle. So in this case, we're saying one customer rep can handle 1,000 customers. And so that's going to define your head count of customers based on how many, your head count of reps based on how many customers exist over time. Then they have a salary here, and they also have payroll tax and benefits. And these will be cost of goods sold, counted as cost of goods sold. We've also got some variable costs based on the total revenue. This is just a basic calculation saying, okay, what was the total revenue, percentage of that using credit card fees, and what your average credit card fee is. You've also got another cost of goods sold section here per customer type to say, now this is just high level, so there's going to be a lot of different variable cost sections to define, and I did that so that it's flexible enough to fit a lot of different situations. In this first one here, we're just saying, okay, every month a customer is going to cost this amount, and you could break that down into detail here, and that's going to flow into this first year, and then you could adjust it over time as well if it changes. But this is just saying, okay, I have 5 customers, they're costing me this amount per month for this this general cost, whatever it might be. Other fixed costs, these are you want to potentially be able to account for fixed cost of goods sold that are not necessarily tied to activity. So you can do that here. Maybe rent or something, office rent. that's directly used for the servers, stuff like that. Payroll tax and benefits, and then down here we have two options for cost per function. So this is going to go with the amount of functions used for each type of customer times this cost, and that's the function as a service provider's cost. This is going to be a cost of goods sold. Also, a second type you can do, so every function that's requested is going to also have this cost tied to it, and you may or may not be using these. Um, depending on how your setup is. And then finally, you've also got data transmission fees here. So cost per GB transmitted. And that's again going to run off of on our revenue assumptions here. We're defining how many GBs are sent per request on average per customer type. Okay. And most of your cost of goods sold, the majority of them are likely going to be these capex, this capex tab. This is where you're going to define, your data centers, networking equipment, servers, every GPU, CPUs, whatever you're offering to be able to provide the function execution, this is where your big costs are going to be. And the depreciation for these items will hit your cost of goods sold, even though it's a non-cash item, a non-cash cost of goods sold, it will hit, so you can see what your margins are with that and without that. Because I'm showing EBITDA and EBIT here, so you can see all of this. We'll go through this here in a little bit, but so yeah, and so to figure out your capacity, you're going to want to make sure okay, am I buying enough to handle the revenue scaling that I'm doing and the customer growth and how many functions they're using and the size of or the GBs that are assigned to each customer type. So what I've done on the CapEx tab is you have your purchase date here in column F. Just use the drop downs to pick, and that'll update based on your launch year on the main control tab. Define the useful life and define the cost basis. So what you're buying this for. You have this, and then you have this down here to see, okay, over time, how many GB seconds are being used per month, how many functions are being requested per month, and how many customers exist over time. And you want to look at this and make sure these numbers line up. Like you're buying this in order to support some level of service here, denominated in GB seconds used in functions requested. And you could do a couple tranches. You could maybe have one here, then in a couple years, that gives you enough capacity to meet, a certain amount of time, and then you have to buy more or refresh or whatever. The model goes for 7 years or 6 years, and usually what I was researching is the general useful life for this type of equipment could be 7 years. Now it depends; it could be less or more, but that means that everything you do in this model, uh, whenever you buy something, it should last for the length the model is forecasting for. But you still could, if you wanted to, account for refreshes and purchases to maintain this capacity and add more. This is all done automatically here. So you just got to make sure what you're buying here makes sense and is timed up with the capacity being used. Okay, so there's that. I want to touch on one thing. For the expenses, you would also account for things like the staffing for the server, the building, maybe security, all that kind of thing you would account for in these fixed cost areas here. All right, so we've got revenue all figured out, customer acquisition, how we're billing, um, retention, we've got variable cost, customer scale. Startup costs, these are just other items that are not CapEx, but maybe you're going to have some outliers, like maybe legal fees, consulting fees, things like that before you actually begin the business. You can account for that here. Debt schedule, this is just simple. If you were to finance any of the startup costs with a regular loan, you could do that here. CapEx we went through extensively. Cap table is just a regular, the model will solve based on your startup costs, and any net operational burn is going to tell you how much cash you need to keep your balance above zero, so to survive. And if you want to have a buffer on this, a reserve, you could always put it in the startup cost, a reserve amount. And then in theory, that says when you, in the model, it says you have cash balance of 0, you would still have whatever is in this reserve. But on this, so this is the minimum equity required. You can define who's funding that, potentially different raises here. They get a share of the company, share of the profits, and then this overflow will take any money that's not been accounted for in any other contributions against the total required and just fill here. So if I were to raise another, let's say 2 million with these investors, maybe they get 10%. We'll lower this down to 30 because these percentages total here plus these need to add up to 100%. So I've got 40, 60, which is good. And then the total contributed funds in here and here should always add up to this minimum equity required. And you can see we've got IRR calculations for the investors here based on the cash flows available to distribute, the contributions. So that's this. Let me undo this so it's just back to the default. Okay. Terminal value, just to define if you're going to put any of this sales proceeds against the depreciable book value of any equipment or not. If not, are you doing pre-tax calculation? You could just put 100% here, or you can zero out these taxes and they'll have no effect. All right, now I want to go to the monthly detail first. So the monthly detail is like the backbone of the model. This is showing you. So we've got customer acquisition. We've got all the subscription pricing if you're going to see what, and this is mainly to see, can you develop a tiered pricing level where they get, customers get a certain level of service and that's it, and they pay a monthly fee. What does that look like? Now, if you zero that out, that's fine. This would be 0 then for MRR, but you also have now billing per function to use. So this is showing you how many functions are used per customer type, how many total real computation seconds are being utilized based on how long each function takes, and the total functions requested per month. And then we have our flat rate. So this is going to look at the minimum. If there's any free, the first X amount of functions are free, it'll look at that and then bill the rest at the rate per 1 million functions requested. Then we have computation. So this is billing based on the GB seconds used, which is going to take the total computation seconds multiplied by the amount of GBs assigned to each customer type on average, which is this here, and figure out what the billing is. So here, in this case, we're saying, for 16 billion function executions at 2.4 billion seconds of execution happening, you can bill out $21,000 in computation fees and $2,200 in flat rate fees. Now we've also got some data transmission in here, 16,000. That would vary depending on if your functions are going to be transmitting any data while they're executing. Now the interesting thing about function as a service is they call it serverless because there's no state update. There's no like database or anything. So the function just turns on, turns off, it provides the execution, that's it. There's no storage being held anywhere or anything else. You might have, stuff being held in RAM as the execution of the function is executing, but it just turns off and on, or on and off, to be as efficient as possible, and just, it's function as a service. That's the name of the game here. And we're just trying to see what you can provide, how much it's going to cost to provide that service over time, based on mainly your initial capex on all that equipment, and then what can you bill out for it as you add customers, and what's the return on investment. So here we've got total revenue. We've now got cost of goods sold. So all these different variable cost of goods sold happening here. Customer service reps. We've got total cost of goods sold from depreciable items as well coming in. This is depreciation from your capex spend. And then total cost of goods sold, gross profit, all our fixed costs hit. Then we have EBITDA, EBIT, any debt service, other cash flow items, startup costs, and then we get down to cash flow and key metrics. So that's, I mean, that's mainly the model. We also have the annual detail, which just shows everything we just went over on an annual basis. We've got visuals here to show annual revenue, gross profit, EBITDA, cumulative cash flow, expenses, customer acquisition costs, average cost to acquire a given customer, customer acquisition cost, which is down here, versus LTV. And this is LTV if you're looking at gross profit versus total revenue. LTV to CAC ratio, average monthly churn rate, customers, customer count by type, customer service headcount, EBIT. I thought this was interesting. This zeroes out the startup costs and the exit and just looks at operational cash flow, including the depreciation costs. So you can kind of see what you're doing, what you're making relative to what it costs per the initial capex depreciating over time versus what you're making on after gross profit and fixed costs are accounted for. So I thought this is a nice chart to call out. Average monthly revenue, gross profit per user, average life of a customer in months, months to pay back your CAC, ARR as of the end month of each month, which is just taking the total recurring revenue times 12. Annual revenue by type. So you've got subscription revenue, computation fees, flat fee function fees, and data transmission fees. Monthly functions executed over time, monthly seconds executing computations, monthly GB seconds used, monthly GB seconds used by customer cohort. So some pretty good visuals there. Executive summary is just going to give you a high level look at your revenue sources, your cost of goods sold, gross profit, EBITDA, EBIT, and final cash flow, as well as IRR and returns of the project, the investor side or pool, and the owner pool. Distributions, here's discounted cash flow analysis. You can just look at the total equity requirements, the total distributions available, and the discount rate of the project, net present value, and then you can also look at that for the investor specifically or the owner group specifically in the chart for that. Then we have the financial statements connected. This is three-statement modeling here. So you've got the income statement, you've got the income statement annual, balance sheet, cash, fixed assets, liabilities, owner's equity, and all that will balance out. Assets equal liabilities plus owner's equity. Let me tell you, this is not easy to do if you've never done it, to connect all these with the assumptions and make all this balance. You got the cash flow statement annual. This is kind of like your uses and sources. And yeah, that's the model. Very excited about this. I can't wait to get it out. I'm really looking to get, since I have such good customer cohort modeling techniques, I'm really trying to apply that to a lot of as a service businesses because there's so many different as a service things out there and they work differently. Like earlier this week, I did a data as a service where you're selling valuable data, completely different logic for how revenue is generated and how the expenses work. Similar structure as far as, you're spending some amount of capex and um, but the data as a service is way different as far as that is, hey, I'm selling you valuable data as a customer through API calls. This is, hey, I'm selling the ability to execute functions. So software developers can write their code and this will execute it all for a fee based on the number of requests, function executions, how long it takes to execute each function, and the amount of GBs used to in use while that's happening. All right. I'll just talk a little bit on the global control here. You just write the name of the company at the top here. That'll go to the income statement. The launch year, just write the year in 2024, 2025, whatever. That will affect all the drop downs. If you do update this launch year, you want to go in and adjust all of the drop downs to make sense, like wherever there's a date drop down in the yellow tabs, which would be, expense assumptions, revenue assumptions are in there, debt schedule, adjust that, and capex. I'll put this back to 2024. You can also determine the end month, so the model can run for any amount of months, up to 72, which is 6 years. You could stop the model at any point. Just pick a stop month and then choose to include the exit value or not. Here we're running it through August 2027. So if I look at the income statement, you can see this will go through to 2027 of August and then exit there. No exit value, so it's just operations. You can see what the effect of that is over time at a high level. All of the logic and math all run off of those assumptions. So monthly detail, you see this stops dynamically. Alrighty. What else do we want to talk about here? So that's good. If you want to purchase a template, it's going to be listed at smarthelping.com under if you go to the home page, SaaS, it's going to be listed right here in the subscription models in this section. I think I'm going to charge $75 for this template. I think that's a fair price. There's a lot of knowledge going into this, and it's a lot of finance knowledge to make the it makes sense to an accountant, also to make sense to investors, and there's a lot of industry specific stuff going on here with this model. So I think that's a fair price. You can also just buy all of these templates for $289, and that includes all of the subscription models, all of the models you see here on this tab, plus anything I ever build in the future. And if you want to buy everything I've ever built, I've done, well, probably over about 170 of these financial models. You can just go to download all templates here on the right sidebar and get everything I've ever built for $9.99, and it includes everything I build in the future. So that's a really good deal if you're looking at, want to learn about finance, want to learn about the unit economics of all kinds of different businesses, and have a nice library to source whenever you're doing financial projections. This can save a lot of time and money. All right, that's about all I got for you. Like and subscribe, and that is function as a service, full financial model. Take it easy, guys.